Great. Well, I want to welcome everybody here in the room. I also want to welcome our folks that are joining by live stream. I'm Greg Brown. I'm director of the Frank H. Hawkins Kenan Institute of Private Enterprise. It's really my pleasure to have us host you here, have our team host you here in our offices. We're going to be talking about driving community investment, which is a topic very close to our hearts here. It's really central to what we do here at the Kenan Institute. We're a nonprofit, nonpartisan business policy think tank. We're affiliated with UNC's Kenan-Flagler Business School. So directly and through our affiliated centers here, we research the most pressing issues on business challenges, looking for innovative solutions to many of the pressing issues that are facing businesses and policymakers today. So as a part of this, we host conversations like the one that we're doing here today to learn from our private and public sector partners about the obstacles that they're facing. We are really interested in how we can tailor our research to the types of issues that are going to be important in practice. We're really fortunate to consider the bank in Richmond as a key partner in these efforts. We've worked just in the past year to launch the inaugural North Carolina Investment Forum, the first ever Black Communities Conference, and really exciting and robust roundtable on the economic impact of the opioid crisis. And with that, it's really my pleasure to hand things over to the woman who's made all of this possible, Jeannie Milliken-Bonds. Jeannie?
We have a panel with an SBIC and an RBIC talking about what they do, their challenges, and then we're going to have a regulator panel and a slide deck that goes through a little bit about how that configures with the Community Reinvestment Act. If you're watching this live stream, you will see a little box on there where you can type in your question and submit it, and we will answer those questions as part of the program. And if you're here in the room and you have a question, you can raise your hand, and we may not have you mic'd, but you can say the question and I'll repeat it, and we'll try to address as many of those as we can. So having said that, what I'd like to do is call Joe Shepard with the Small Business Administration up, and then we're going to hear from USDA via video.
Again, I want to say thank you to everyone that played a part in bringing us all here together this afternoon. We appreciate our host, the Kenan Institute of Private Enterprise, for providing this beautiful space and this wonderful facility. Also glad that SBA could participate in the North Carolina Investment Forum and be part of that. And Greg, I think Frank Kenan would appreciate what we're trying to do here today to foster entrepreneurial spirit and stimulate economic prosperity to improve the lives of the people here in North Carolina, but also around our wonderful country. We're going to hear from Betty soon. I think Betty and I share the fortune of being part of an administration that seeks to support and encourage increasing investments into rural America. Many of the things we're going to be touching on today. Looking at our attendance as we had our discussions with Jeannie, both here in the room, but certainly virtually, most of you are familiar with the Small Business Investment Company Program, or the SBIC program. So I'd like to move past the overview of how the program works and focus more on the relationship between banks and Community Reinvestment Act, or CRA, eligible investments. So just have a few brief comments before we get started. As the SBA Associate Administrator for the Office of Investment and Innovation, which is the office that's responsible for overseeing the SBIC program, I'm certainly well versed, as all of us are at SBA, and what an important catalyst the CRA can be for bank investors into both our RBICs, RBICs, but also SBICs. And certainly can't understand or can't underscore enough how much we at SBA appreciate this type of cross-training that we're going to be involved in today. Best practices dialogue, which we're going to be having today among the regulators, the community development specialists, the banks, the current investment fund managers, as well as prospective SBIC and RBIC applicants that are here today. CRA credits are an important factor for bank investors. Bank investments have become a large part of the capital formation that takes place for small business investment companies, particularly in areas where investment capital is not in adequate supply. Bank investments assist SBICs, who then invest in qualifying small businesses. During the past fiscal year, 2018, which ended on September 30th, banks and other private sources of capital combined together with our SBA guaranteed capital to provide an estimated $5.5 billion in financings to approximately 1,152 U.S. small businesses. What some of you may not know is that USDA's Rural Business Investment Company program was modeled after the SBIC program. The RBIC program was created in the 2002 Farm Bill, and SBA worked closely with USDA to draft the regulations for the RBIC program. Although the RBIC regulations are part of USDA's regulations, the regulations track almost section by section SBA's SBIC regulations. So, in other words, both investment programs share a very similar framework, with the important distinction that RBIC's activities in terms of investment are focused almost entirely in rural areas. In April of 2018, USDA Secretary Sonny Perdue and SBA Administrator Linda McMahon signed a memorandum of understanding between USDA and SBA to promote stronger businesses and agricultural economies in rural America. As part of that effort, SBA and USDA have collaborated in finding new ways to encourage SBIC and RBIC investments into rural areas. During the past 4 years, the dollar amount of financings from SBICs into small businesses located in rural areas has averaged around $700 million, or 12% of the SBIC program financings each year. However, we'd like to see an improvement in the level of investing in rural areas. And toward that effort, this morning as we held our first Rural Investing Roundtable, again here at the Kenan Institute, we heard from SBIC and RBIC managers on how our agencies might be of assistance to encourage investing in rural areas, and it was very productive, and we hope to and plan to have more of those. Through our joint efforts under that memorandum of understanding, USDA and SBA seeks to cross-promote both the SBIC and the RBIC programs. The cross-promotion is why USDA is here today with our partner, and why RBICs are highlighted alongside SBICs for the purposes of this CRA cross-training workshop. Under CRA, both SBICs and RBICs are qualified community development investments and therefore can qualify for CRA credits. And we'll be talking more about that this morning, or this afternoon rather. For those of you representing banks that are not familiar with RBICs, I would like to introduce you to USDA's David Chesnick. David, thank you for being here. And get to know David, and certainly after we wrap up here, say hello. Many of you know also recently that the Office of the Comptroller of the Currency published an advance notice of proposed rulemaking requesting comments from the public regarding changes toward modernizing of the Community Reinvestment Act credits, or the Community Reinvestment Act. SBA and USDA met with the Office of the Comptroller of the Currency in May to visit about CRA credits and discuss the clarifications that are important for capital formation for that to occur in both the SBIC and the RBIC program. So we'll continue to engage with OCC during the rulemaking process as appropriate. That's not to say that potential changes will be coming anytime soon, but at least not for the purposes of some of the things that we're going to be discussing today. It's all in the beginning stages of rulemaking, which of course takes some time. Bank investments into SBICs and RBICs are just one part of a broader modernization goal as we talk about Community Reinvestment Act and the credits associated with the Act. It may be helpful to keep in mind that the Comptroller of the Currency has a request for comments that's in mind as we go through this afternoon, to be thinking about that, especially during the Q&A that's going to follow up as we do that near the tail end of the workshop. And any clarifications any of you may seek under the current CRA guidance, it might be helpful for you to ask some questions, especially to hear those questions for those of us that are trying to represent your interests in the rulemaking process as we attempt to make our efforts to contribute and modernize the Community Reinvestment Act credits in the CRA as we move forward. Jeannie, I'll now turn the presentation back over to you so we can get started. But again, thank you for allowing SBA to participate. Thank you to the Kenan Institute. We're all glad to be here and look forward to our conversation. So thank you very much.
Hi, I'm Betty Brand, Administrator of the Rural Business Cooperative Service at USDA Rural Development. Thank you for your gracious invitation to speak to you. I apologize that I could not join you in person, but I want you to know that your input is important to us. On April 25th of last year, the President established the Interagency Task Force on Agriculture and Rural Prosperity and named Agricultural Secretary Sonny Perdue as its chair. The function of this task force was to identify current and upcoming challenges related to quality of life, economic development, and innovation, as well as to recommend solutions for building lasting prosperity in rural America through efficient harnessing of our resources. The report issued to the President by the task force identified a pressing need for support in furthering development of the rural economy. The report includes recommended actions to leverage existing market opportunities, increase agriculture and forestry production, boost production of all sources of energy, including fossil, fuel-based, and renewable energy, and modernize rural America's infrastructure. Importantly, the report recommends that actions supporting the rural economy should start with access to rural capital. I believe you are here today joining in this discussion because you understand that rural businesses and entrepreneurs often have difficulty accessing capital to help them grow and expand their businesses. According to FDIC data, over the last 40 years, more than half of all banks in America have closed. In rural America, the effect is even more pronounced due to the declining population, low population densities in rural communities, and the relatively small numbers and sizes of rural businesses. Some rural businesses with growth opportunities are unable to qualify for or gain access to capital to help them expand. Wall Street capital firms and private investors have struggled to access rural markets. We believe that more public-private sector opportunities should be sought to support rural America. Under the Rural Development Mission Area, our agency, Rural Business Cooperative Service, includes programs that offer technical assistance and grants to rural entrepreneurs, cooperatives, and rural communities to assist in economic and business development planning activities. We offer loans and grants to non-bank lenders to establish revolving loan funds to startups, expand small businesses, and support micro-entrepreneurs. We provide loan guarantees to commercial lenders to finance the startup or expansion of rural businesses and to finance renewable energy systems and biorefineries. The Rural Business Investment Program is our only program that focuses on the equity capital investment needs of rural businesses. We are interested in expanding public-private collaboration and helping rural communities identify and develop projects that are appropriate for private investment. This roundtable is a great opportunity for us to hear from you. Thank you for your engagement in this discussion.
Thank you. So let me introduce our panelists. Karen Gregory is a partner with Blue Highway Capital at RBIC. And Karen, we really appreciate you making the trip to Chapel Hill today from Boston. So it's great to have you here. And Rhonda Penn is the CFO with Plexus Capital in Raleigh. So thank you for being here as well. And what I'd like to do is have you each talk a little bit about RBIC, and Rhonda's with an SBIC. Talk a little bit about your organization and convey any thoughts that you would like before we have some question and answer.
Sure. Shall I start?
Go ahead.
All right, great. Well, thank you so much, Jeannie, for putting this together and for the Kenan Institute. It's great to be here on behalf of my partners, Alex Mood and Christine Jones, who we are based in the Northeast and the Mid-Atlantic states. We came upon the RBIC program back in actually late 2014. We were exploring an opportunity to find a way to put a fund together that would actually benefit an underserved market. And we had backgrounds in investment that actually demonstrated to us that you could make outsized returns, but also have a terrific impact in rural areas. And we had, in our past track record, had done it somewhat unintentionally. So the RBIC program seemed like a terrific vehicle for us to leverage our experience and to really work within that program. And because it focuses on rural businesses, we knew ourselves that a lot of businesses may get support when they're very, very early getting started, but once they start to grow, it's very hard to find private equity. And we also had learned that even banks, again, not only were they disappearing, but they also, many of them are not doing a lot of C&I lending. They're really focused more in the real estate side. So we were troubled when we looked at some of that to see that not only was there very little equity in rural areas, but there was almost a lot of it was very little lending going on. So we set about to work with Dave Chesnick and appreciate all of the effort in terms of getting us into the program. What was exciting for us was that farm credit banks could participate, actually had to participate. They had no other sources, no other ability to invest in a private equity fund other than through the RBIC program. So that was, although the SBIC has leveraged through the SBA, this was for us an exciting partnership that was an automatic partnership to help us into the rural areas. So a shout out and thank you to Farm Credit East in our footprint and to CoBank for stepping up and participating. The other important and exciting part was thinking about the community banks. Seemingly the CRA credit was an automatic. And we marched out into the marketplace saying, you know, this is a great partnership. We want to have, you folks are on the ground, you know the local community, you're seeing the companies that actually are in the growth mode, where maybe you can't lend any further to, but they could really use a layer of equity, and patient capital is another way to look at it. So our focus and our strategy is to focus in the Maine to Maryland footprint primarily, although we can invest opportunistically throughout the country, but to really focus on those businesses that are looking for growth capital. So our strategy is a growth equity, structured equity model, where we're either doing subordinated debt with warrants or we're doing preferred equity. And so as we went into the marketplace, we also recognized that this has impact. So we've also been able to attract foundations that are very, very interested in the impact aspect, because our two pillars what's important to us is not only getting an absolute risk-adjusted return back to our investors, but also to create quality jobs and to have shared prosperity for the employees that are working in these small businesses in rural areas. So we have been very excited about trying to fulfill the mission of the USDA by having a broad base of limited partners who can really help us create a continuum of capital into rural America. What I think that we thought again that this was an automatic. This was community development, economic development, and investment in your community by a bank who would participate in the RBIC fund like ours, and we have several brethren that are also out there in the RBIC program, and it resonated a lot, and we have several bank partners, but for many of them, the challenges for them were it was a newer program than the SBIC, and they weren't convinced that they had had some experiences that led them to believe that perhaps it wouldn't be qualified and they wouldn't get CRA credit for the initiatives that we were undertaking. So it's been a little bit of a challenge for us to convince them, and it's wonderful to have this workshop today because we can convince them all day long, but when they hear from their regulators, it makes it a lot easier. So with that, I'm actually going to stop, and we can probably have more conversation in the Q&A.
Thanks, Karen.
I'm Rhonda Penn, and I'm the CFO of Plexus Capital. And Plexus Capital started in 2005, started operating in 2005. We are now investing out of our 4th SBIC fund. We have all of our SBICs are debenture funds licensed with the SBA. We are about 2 years into investing out of Fund 4. We invest in small privately held businesses with mezzanine debt behind the senior bank. We look for privately held companies that have EBITDA of less than 10 million, usually revenues between 10 and 100 million. And Plexus will invest anywhere in the country in any industry if we can find an industry expert to help guide us through it. And as Bob Anders always says, if the business is simple and we can understand it and it's not too complicated. And so we work closely with the SBA, and Joe Shepard has been very helpful to us as we've navigated through many years of working as an SBIC and investing in small privately held businesses.
Thank you. So let me ask you both, based on your first comments, to talk a little bit about just challenges in attracting investors. So I'm sure you have some.
Yes. Well, I think, again, I would say a couple of things. One is that the rural aspect of the program. I think that there's a bias that you should invest in cities where there's high growth, high tech-oriented businesses, and so how could you possibly earn, how could you get a return for investors? So I think that in some cases has been a challenge. Again, based upon our strategy, we're looking for companies that are in the growth mode of looking at, they have revenues of 5 to 50 million and are profitable, but again are in a growth mode or perhaps an acquisition mode. A lot of family businesses fit that profile of what we're looking for, where they're looking for an intergenerational transfer from one generation to another. And so although our strategy is a pure private equity strategy and a growth equity strategy, I think the fact that we're focused on looking for businesses, there's a bias and a somewhat of a sense of, well, can you get exits? Can you find good deals, and can you get out of them? So that's certainly been something that I think has been a theme, I would say, across our investing thesis.
I think what we've found is finding investors who know about the SBIC program. I mean, so many people don't know, and most of the funds, the SBIC funds, have limited resources. So when we are raising a fund, we're still investing out of our previous fund. We're small teams, and so trying to get out there and meet the person who's making the decision to invest in an SBIC, who will listen and take time to understand the program. I do know from attending a conference and hearing some folks from the SBA speak that the SBA is focused on getting out in the marketplace more now also, and educating investors and companies looking for lending. But limited resources are tight with the SBA also. But it does seem that once we get to the decision maker, especially with financial institutions and banks, that they are interested. Two primary reasons that banks invest in SBICs is for the performing return and the CRA consideration. So I think just reaching the right person who's willing to listen to the opportunity that they would have to invest in an SBIC is a challenge to us.
Yeah, I was wondering if you wanted to elaborate, either or both of you, on the challenges with financial institutions. Obviously, we have via live stream a number of financial institutions listening, learning. Did you want to talk a little bit more about challenges?
Sure. I think, generally, a little bit to your comment, Rhonda. I think, depending on how the institution is structured, we have tried to reach to the CEO or CFO, and it depends on where the CRA officer or the CRA decisions are made, and oftentimes we might get to the CRA officer first, and depending on whether or not CRA is just, yes, we should have CRA, we need to have CRA, but that's not really our motivation at the bank level, or is it oftentimes we've found, to our surprise, that at the high end of the institution, the leadership is very interested in making new investments and expanding their CRA footprint or their profile, and really investing in their community in ways that they haven't. And so oftentimes they're then asking the CRA officer, well, we really want to do this, so would you please, make sure that, find a way to make sure that it meets the regulatory requirements, which then, we've provided a lot of information around what guidance exists, et cetera. And I think the other, for us, we're pretty industry agnostic, so again, the other, many of them will say, well, we don't have a lot of agricultural industry, in our assessment area. Well, that's fine. For our particular strategy, we're agnostic. We're looking at industries from transportation and logistics, and we certainly are looking at food and aquaculture and things of that nature, but we're also looking at specialty chemical and software companies and business services. So we have to sort of make sure that they understand that. But I think it really has depended, and the CRA officers are the ones on the ground with the examiners, and that's been the other question. We've gotten banks who seemingly were quite interested, were ready almost to say yes, and they had an exam or had an examiner who basically either discounted even the SBIC investing that the bank had done, and therefore when they said, well, we're not going to get it, we're getting told we're not getting credit for the SBIC investment, so we're certainly not going to get credit for anything with you, so we're not interested. And that's been really frustrating for us because we are so excited and passionate about the opportunity to grow this program, not just for our own fund, but to grow the whole program and to see the SBA doing more also in rural. And it's so important to the economy of the country. So I think it's just, getting banks comfortable and getting getting the CRA officers perhaps, to be able to tell stories. I know we've got one of our bank LPs was hoping to come today to talk about, about their excitement and what we're doing. And it's all about storytelling. So much of it is, if we tell them, here's the kinds of things we're investing in, it's easy for them to tell that story back in a way that, again, meets all the regulatory parameters around the equity investing profile. So I think it's there's been a lot of inconsistency in terms of how the banks hear how the examiners are actually, assessing this program.
We love having banks as investors. Banks do what we do, so they understand the challenges that we face, and when asking for information, they understand the information they receive, and it's easy for them to interpret it. I think we have around 250 investors across our funds. Some obviously invest in more than one fund, and of those 250, 35, 36 are banks. The other opportunity we have when we have banks as investors is it gives us somebody to call up when one of our portfolio companies needs a senior lender in there. I think some of the challenges that we have in working with banks is trying to help banks with information related to CRA, and the information seems to be a bit inconsistent and hard to follow. So it's my responsibility to report that information, and I would welcome any ideas or thoughts that you have on how we can provide better service to our bank LPs so that you can get the most out of your CRA opportunity with your investment in us.
Let me see if anyone in the audience has any questions. Yes, Peter.
I'm the executive director of Reinvestment Partners, a nonprofit advocacy community development. I'm wondering if one of the questions from regulatory CRA compliance is that yes, an SBIC or RBIC is an eligible investment, but is it also where the dollars end up? Does the investment placement have to be in their assessment versus across the geographic area of service?
Yeah. So the question that we have for both is whether some of the confusion is about the dollars and the placement needing to be in the assessment area under CRA.
So I do understand that that has been confusing, and confusing to me too sometimes. I think that it depends. It depends on the bank, what their assessment area is, and how the regulator looks at it when they are considering it for CRA. Obviously, if we are investing in your assessment area, it's pretty easy to figure out. As I said earlier, we invest anywhere in the country. So I have understood from talking with people and some research I've done on my own that the investment does not have to be directly in your assessment area, but it has to benefit your investment area. So if it's in a surrounding area and you have people who live in your assessment area, then perhaps you could get CRA consideration for it. But I think that that's just a matter of gathering as much documentation as you can and presenting it to your regulator to see what their answer is. Do you have more?
Right, and I think that that's, again, our expectation. And again, with banks that have been very confident and have signed up with us, right away, they were very comfortable that even though we may not invest everything in Maine, and we won't, that if they were a Maine-based bank, that we're making best efforts to be looking in their assessment area, and that is actually what they understand, that counts, and how many dollars we invest, the underlying investments are a secondary consideration. But as long as we are focused in the footprint that they are also, they are also considered. I think what's exciting is a little bit around this modernization that the OCC is looking for and the other regulators are looking for, because it sounds as though there's maybe an opportunity for a bank to not just be looking at where their deposits are or where their retail operations are, which would help us as well as we are trying to, make best decisions about putting investments with growing companies that will have a benefit to the region and not necessarily just to that town where that bank, maybe headquartered or located. So I think things are coming together, which is great. But I think it's really important. Again, I think that clarity is really what has been lacking.
Brett.
I'm Brett Lane. Question maybe for Karen, about the farm credit system, the investors in your RBIC, do they have the same kind of CRA credit motivation that the bank partners do? Given that they probably have a little other experience investing in funds, how do you feel with them in terms of what their motivation is?
So I'm going to repeat the question for the live stream audience. The question is regarding the farm credit system and the investors, whether they have the same types of motivation for CRA.
And I might defer to our LP, actually, to Dave Dombier from CoBank, who actually could probably address some of that question.
Oh, wait, let's give him a mic. We're going to give you a mic.
But the program was designed with the Farm Credit Administration in mind to actually require them to be at 10% of the total capital in the fund. I'll talk while you get mic'd. And the actual opportunity, what we've done is we've asked them to not be more than 24.9% of our fund so that we could be somewhat industry agnostic. But we could have had the opportunity to be an all agricultural related fund by taking in all or most of our capital from the farm credit banks. But Dave, you may want to comment on the CRA piece, because I don't believe that's as much of a driver.
That's right. So Dave Dornbeer from CoBank, and CoBank is a $120 billion farm credit bank, part of the farm credit system. It's a government-sponsored enterprise, and the Farm Credit Act dictates our lending authorities. And so we don't have CRA, but we have a laser focus on our mission of serving rural America. So that is lending into agribusiness and rural infrastructure, as well as serving the totality of our mission, which includes being able to invest in rural business investment companies that drive more capital into rural economies. In assets, $120 billion. Why is it worth? We're owned by our borrowers, and we return most of that to our customer owners.
Thank you, Dave, for helping me answer the question.
Thank you. Other questions here in the room? Okay.
I'm curious, how much capital are you controlling? How much of an impact are you making?
All right, so the question is how much capital you're controlling and what type of impact you're making.
Rhonda, do you want to answer since you have Fund 4 and we are a new fund?
So we have, across our 4 funds, we have raised $950 million. We've invested in 88 investments. Our investment size in the beginning was $2 to $3 million. Now it's more between 10 and 15 million. So we have moved up in the amount that we will invest, but we have stayed in the same market. So we have not moved up to larger companies. That my team calls that sticking to what we know. And so we've found that that's worked well for us, even though my team is full of idea partners who always want to investigate new and different opportunities, but have decided that this is what we know how to do, and we're going to stick with these size businesses. Does that help?
It does. So it's about $1 billion over 13 years.
Yes, 13 years since 2005. We're beginning to talk about, hopefully Joe's heard this, we're beginning to talk about Fund 5. It takes a while to round up investors, and so you have to sort of start talking about it before it's time. So maybe over the next couple of years we hope to have a Fund 5 SBIC. So our Fund 1 returned about 10%, a little over 10. It started in 2005, and so the middle of it was right there during the recession. Fund 2 started in 2009 when banks were not lending, so we had a lot more opportunities. It is about to close, and we are right at 24% right now. So that's we may never ever see that again. But we expect that our Fund 3 and 4 will fall somewhere in between the 10 and the 24. I think we are anticipating that Fund 3 will be 12 to 15, and Fund 4 is really too young to predict right now. It all depends on deployment. Deployment's been a little slow for Fund 4 this year, but it's starting to pick up now. It's funny how it goes in cycles like that. You're welcome.
And we're a new fund, so we haven't deployed capital at this point. We're looking at some deals where we can start deploying capital probably the beginning of the year. But we are underwriting to 2.5 times our MOIC and a 25% gross IRR. And again, it's a growth equity strategy, and that's actually what our track record of 54 investments from the past demonstrates, actually even demonstrates a 32% IRR in rural businesses. So we know that there's a real opportunity out there that is underserved. So we're looking forward to that, and we will invest $1 to $3 million primarily in businesses that are, again, 5 to 50 in revenue, and looking for some growth equity layered onto their senior lending and other lending.
Other questions? Oh, okay.
They'd like to know how much of the $950 million plus capital is leverage capital from SBA. How many should all the companies?
950. Okay, let's see the 950.
While you're calculating, I'll repeat the question. So the question from someone watching on live stream is how much of the $950 million for Plexus Capital is leveraged by the SBA?
You guys are challenging me without a calculator. Let's see. It's be around 4 something. Let's see. Hold on. We have 150 from Fund 4, 150 in Fund 3. It's about, I think, 75 out of 2, and then another 50 for 1. So what's that? 425. Yeah, 425 from the SBA.
Great. Other questions in the room or online? Okay, well, maybe I also just want you to, be able, we've had a lot of conversations about this before today, but, just other information you'd want to relay, especially, to the financial institutions that are listening.
Right. I think for the RBIC program, it is, it's super important. I mean, I agree with Rhonda at Plexus to have community bank partners. They are the boots on the ground. They are the community lending teams, and we've been meeting with a lot of them for the LPs that have already signed up. They know their communities. They know the customers that perhaps they have lent to and now need equity to bolster that lending opportunity or that lending relationship. There are other instances where banks can partner with us because they are looking at a new business that they'd like to lend to, but perhaps they don't want to lend too much to, but would think a structure where there's some layered in some equity from us. So we've been talking to the community, to the commercial lenders about those opportunities where there's a business that either we can bring to them. There's a lot of businesses in rural areas that have basically grown organically, where they haven't sought much of maybe a line of credit, and they really could recapitalize in a very effective way with a really good bank partner. So, CRA is very important to these banks, but I think that the excitement that most of them have seen with the program is the partnership that comes from working with us in rural areas where we're learning from them and they're learning from us in terms of other opportunities that we're seeing. So I think that, it is very clear that there's underserved regions of this country that need desperately to have equity capital. And that's why this program, the RBIC program, is so important and vital to be able to be this facilitator of farm credit dollars and community bank dollars. We've had a lot of strong interest from impact investors, foundations, and family offices that also really like the story and like the fact that we have a broad base of LPs. So I think, for banks, it's really looking at a diversification strategy when they're looking at small businesses, not just, a lot of them do housing and real estate oriented programs, but for them to be able to also say that they're not only supporting a housing project, but they're supporting a small businesses in which those people who live in those housing projects can work. And that's really trying to help low and moderate income people become more prosperous in rural areas is really one of the underpinnings of what we're trying to do with the capital that we're seeking to deploy.
So I think two things. And the question about the SBA debt made me think about this. If you're a bank considering an investment in SBIC, know that to be an SBIC and get your SBA license, you really have to prove yourself. Your team, the SBA mostly focuses on your team, on management, on their background, on their experience, how long have they been together, which partner or member of the team plays what role in the firm. And so the SBA takes a really hard look at that, and the licensing process is tough, and rightfully so. We're borrowing millions of dollars, hundreds of millions of dollars. And then secondly, just what I mentioned earlier, get the word out there. The SBIA is an association that assists SBICs, and I visited some senators and congressmen in D.C. About 6 months ago to tell them about the program. They just didn't know much about it, and I was surprised. And so we need their involvement to help so that we can deploy these dollars into small businesses and help companies grow and grow jobs. So just spread the word, and please feel free to call me if you have any questions and need my help.
Jeannie, oh, sorry, go ahead.
Yeah.
I was going to say, and I I would say that although we don't get capital from the USDA, the licensing process is also fairly rigorous for us, and many interviews and lots of due diligence. All the limited partners, no matter whether you're the Farm Credit Bank or community bank, there is no advantage or any preference. Everyone is treated pari passu, so every investor, regardless as to where they're coming from. So that's a unique difference, and in some cases, for some investors, it was an important difference to get them interested. But it is definitely the same, the goal of trying to support the team that's out there with their expertise, because they don't have the expertise necessarily make any direct investments, nor can they make direct investments in companies and on the equity side.
Karen, do you want to say anything about the leverage versus unleveraged? Or if that's unfair to you, I'll ask David to talk about it.
Well, I mean, right now the program is unleveraged, and I think for us, we found that to not be disadvantageous because we have the opportunity to partner with farm credit banks, and so that's our form of leverage, if you will, that we can partner with them, and their capital has to come into these funds, so it's not, we can't tell them no, because we wouldn't have a fund without them. So that's what I would say. David, you may want to augment that answer.
All right, so I think we have a question.
What is the smallest LP commitment you could take from community banks in an RBIC or SBIC? 100,000, 250,000, or $1 million?
It's really dependent on the fund. There's no requirement from the USDA as to how little we take. For this fund to be scalable, we would like to see $1 million commitment, but that's up to the general partners. It's subject to the discretion of the general partners to take in less. And if it's a very, very small bank with very small asset base, they're unlikely perhaps to be able to do $1 million, but for us, it's just important to get their buy-in and their support for the work that we're doing in rural areas.
Same here. We'll start every fund with a threshold, and then we start talking to investors, and we usually make concessions, and we like investors, and we love what we do. So typically we'll start out with $1 million or $2 million, but we have many $250,000 investors and $500,000 investors. So it depends.
Any other questions?
Did you?
Yes. All right, so the question is whether there's extra credit for exporting or working with manufacturers.
Not in SBICs.
And not in this either.
Other questions? Yes, Brent.
I have a question about the deploying capital.
Yes.
You're often the first external money in your deals. I would assume not a lot of experience in equity investment in rural areas. Do you find any resistance on the management and the ownership side for introducing external capital because they're previously open internally on? What kind of problem? If you go get the term sheet, you often find you have to educate on the management and the ownership side.
So the question's about ownership resisting in the capital deployment side.
So I'll speak to a few stories. I think for all of us, my partners and I, we appreciate that it's not a transaction, it's a relationship, and it takes a lot of trust and discussion, and many owner-operators are not what we would maybe call fluent in fundraising. They're busy running their businesses, and they're not going to get in a suit and drive to New York City or to a big city. So we already know that. We appreciate that. The deals that we're looking at have come to us via a bank partner or a trusted professional colleague who already knows us personally and feels comfortable that we'll listen and will help to solve the problem. If they're coming for capital, there's a reason that they finally decided that they really need outside capital. And many of those are owner-operators that have owned the majority of their company. We take minority stakes in the company, so we come in we're not in a buyout, we're not a buyout fund, so that eases the tension somewhat. We're going to take a board seat and we're going to professionalize them and help them with some management team issues, but The discussions we've had to date, there's been a real, I think there's been a real joint effort to really trust, build that relationship and that trust. And at the end of the day, the owner-operator really wants to grow and scale that company and hire a lot of people. And so they're really looking for us to help and bring our expertise to the table.
So just as Karen said, it is an investment in people. So just like anything else that you do, when we are looking at investment, we really dive into who's the management team. It's a pretty thorough process in looking at each person and background checks and just getting to know them. Several members of our team will visit before a term sheet is signed, and then after the term sheet is signed, there's a lot of due diligence that goes into it. So you really get to know each other, and it can, you can get into some pretty healthy conversations and discussions. But what we found is that usually brings everybody closer, and so when the deal is signed, you work better together and you know each other. There have been some cases that the owner, CEO, other members of management did not work well with us. And if that's happening early on, you may as well not go get married, because it's not going to work after that. So there have been times that we've walked away for that reason.
All right, so the question's about exit strategy.
So I'll speak to our strategy in terms of a growth equity strategy. So our hold period is 3 to 4 years. We are looking to exit 3 ways home, as one of my partners likes to say, to potential LPs. So we can help an owner-operator put together a strategic sale. Many of them are at that stage where they'd like to be sold. That's an easy way out. We can also look at dividend recapitalizations and have a successful track record where that has brought in multiples on cash to be able to exit that way. So we don't force them to, if they're not interested in being sold, we will structure a relationship such that we get our 2.5x back during that hold period, but that they can continue to continue to grow the company. There may be a third way, which is that another entity, another group comes in and recapitalizes and basically takes us out. So that's our strategy. It's unique to Blue Highway Capital.
So as an SBIC, we are set up as an SBIC model. So the life of our fund is 10-year life. We invest the first 5 years and exit the last 5 years. So we invest in debt, in mezzanine debt. So most of our loans have a term of 5 years, 5 to 6 years. And we've reached some of those points where the company was having a difficult time refinancing, and we've helped with referrals. Banks like you, sometimes they've improved to a point where then they can get senior lending. We call Kevin at Salem. And that's actually happened a few times.
Okay, correct. Yes. Question.
Hey, so you guys are interested in the impact that happen in rural communities, obviously. I was just wondering if you had any ways that you measure or track the impacts that are actually happening, or if the investors are interested in this kind of work, how you see that.
Good question.
So the question's about metrics in terms of the impacts on the community.
So for us, we're partnering with a firm called Next Street, and they're nationally recognized in terms of impact consultants. The USDA requires us to report annual metrics, and we are reporting on jobs, but we've matured and sophisticated our program that we're looking at quality jobs, not just jobs created. So that means, is there a career path? Are there benefits? Perhaps stock options for those employees? Are there training programs? Is it a fair and engaging workplace? So we're developing a metric tool that will measure that during diligence as well as when we make the investments. The shared prosperity is another aspect, and so we're very deliberate in terms of being able to not only measure it, not just because the USDA requires it, but our LPs will benefit from those metrics and the stories that we can tell behind those that will help them again with their CRA during their exams.
So quarterly, we are required to report to the SBA financial statements. And in the information that we submit to the SBA, it includes number of jobs for the companies that we've invested in, and along with an income statement summary that includes revenue and EBITDA. And I know that the SBA reports that out. They consolidate all that information and then report it out to industry.
Okay, great. Thank you so much, Karen and Rhonda. Appreciate that. Okay, so we're just going to switch out and have the regulator panel with OCC, FDIC, and the Federal Reserve Bank of Richmond. Okay, so regulator panel. So we have today Jenny Chow, who is on the phone, and I'm going to help her with PowerPoint. She's with the Office of the Comptroller of the Currency and U.S. Treasury. Rob Porter, who's with the Federal Reserve Bank of Richmond in the Supervision and Regulation Division, and Victor Galloway with the Federal Deposit Insurance Corporation, the FDIC. So we are going to start with Jenny, and I'm going to do the slides for her.
All right, I presume everyone can hear me, and it's a little disconcerting because I'm sitting in a room and I can't see anyone and I can't hear anything except for myself, so hopefully this will go okay. But hello everyone, I apologize that I can't be there in person today. I actually have a compliance conference here in New York, so I've been sitting at a virtual conference for the last 2 days, so I feel for some of those of you who are calling in virtually. So I know it's the end of a long day. I'll try and keep this as short as possible. I do have a short presentation that hopefully will touch on some of the questions you have regarding SBICs and RBICs and how they can qualify for CRA consideration, as well as the types of documentation that would be beneficial for the banks to have to provide to the examiners. And I did catch some of the presentation, the last presentation, so I know some of it was covered, but I'll try and go over that to start to clarify some of the questions you might have. But before I get started, I did want to make a brief announcement. As many of you know, the OCC issued an advance notice of public rulemaking, or an ANPR. They issued that via the Federal Register on September 5th, and it's on the topic of CRA modernization, so a lot of you have heard about that. And, you know, the purpose of the ANPR is to see comments on the best way to modernize the CRA regulatory framework. So I know the Fed is hosting separate but related listening sessions, and I hope many of you will be able to join those sessions if you can and submit your comments, because your feedback is very important. But I'm not going to talk about the ANPR today, nor am I soliciting your comments. I just want to encourage all of you to submit your written comments by November 19th. So you can refer to the Federal Register for specific details on what the OCC is asking for. But note that, you know, the OCC invites all comments and suggestions for ways to improve the CRA regulatory framework, not just those that are outlined in the ANPR. And also, if you are comfortable submitting on your own, you can obviously submit as part of a trade group or an industry group. So this is a great opportunity, and a rare one, for your voice to be heard on how best to modernize CRA, including, for example, what I heard earlier, how to clarify it and expand it. So I encourage you to submit your comments by November 19th. Okay, so let's go to the presentation. In the interest of time, if we could just hold all questions to the end so we can get through the material first, that would be great. Okay, Judy, do you want to turn to the next slide? Jeannie? Oh, sorry. You can turn to the next slide. Oh, okay. All right, slide 1, actually. I'm not sure if you're on that slide. I can't actually see what you're doing. So basically, in a nutshell, everything is really on this page. Everything you might want to know about how RBICs and SBICs qualify for CRA, in a nutshell, is really on this page. So if we run out of time, you can just refer back to this page. But just so you know, banks do have the authority for investing in SBICs and RBICs. And they have that under two different authorities, one of which is the Public Welfare Investments which allows banks to make investments designed primarily to promote the public welfare. And that's, that's one authority. The other is banks also have the authority under the Small Business Investment Act of 1958 to invest in one or more SBICs. RBICs are a little bit different. They were created by Congress under the Rural Business Investment Program, but banks do have the authority to invest in RBICs under Part 4290 of the Rural Business Investment Company. And I hope I have that right. I know we have the experts on the line, but I think that's correct. Is that correct? Yes, okay. All right, great. So anyway, so they do have authority, in case banks are wondering, because a lot of times banks can't make investments, but RBICs and SBICs are an exception. And as I heard stated earlier, SBICs and RBICs are definitely qualified community development investments under CRA. And I know sometimes banks, they run into examiners who aren't sure about this or they question it, but this is made very clear in what we call the CRA Q&As, which were issued in 2016. They specifically refer to RBICs and SBICs as qualified community development investments, and we will talk about that in some of the later slides. But just to be clear, they are eligible for CRA consideration. Whether or not your bank receives credit depends on the geographic requirement, and we will talk a little bit more about that in later slides. The third point, banks can receive assessment area consideration if the fund invests in a broader statewide or regional area that includes the bank's assessment area. So I know that was touched on earlier. I know this is the point of confusion, and we will talk about it more. But generally speaking, if the fund perspective says we're going to invest, let's say, in the entire state of North Carolina, and your assessment area happens to be just Charlotte, the bank can receive consideration even if there's never an investment made in Charlotte. So we'll talk about that more. I know that's a confusing point, but yes, the banks can receive CRA consideration as long as it's covering their assessment area. And the last point, just like any other investment or community development loan, the examiners will certainly consider the dollar amount invested, as well as the innovativeness, complexity, and responsiveness of the activity. And this becomes important with the documentation, and we will talk further about this as we go on. Okay, the next slide, please. Okay, so this should say why banks invest in SBICs and RBICs, hopefully, because I'm not seeing it on my end. And I know this was touched on earlier, so I won't spend too much time on the slide. Obviously, the banks are looking for a competitive return on invested capital. The RBIC or the SBIC has to make the case that its potential investor, to its investors, that its business model is sound. But the returns tend to be very attractive because of the SBA or USDA leverage, because they're subsidizing it. So it makes the cost of funds lower. So the returns are usually better than relying on private capital. And also, as I heard mentioned earlier, there are small business development opportunities, and it goes both ways. Often the RBICs or the companies in the portfolio may need banking or commercial banking, so they may be referred back to the bank investor. Or sometimes the banks get customers that just don't qualify for traditional lending, so they may refer it to the RBIC or the SBIC for an opportunity for obtaining capital through that route. The other reason why banks might want to invest is because RBICs and SBICs are exempt from the Volcker rule. And as some of you know, the Volcker rule prohibits banks from ownership of hedge or private equity funds. So both SBICs and RBICs are exempt from that rule. So they are allowed investments. And then, of course, the last one, yes, the banks, the investments in RBICs and SBICs are eligible for CRA consideration. And of course, the large banks and intermediate small banks, they can receive CRA consideration under the investment test, or if you're an ISB, the community development test. And again, as I mentioned earlier, this is clarified in the CRA Q&As. And if you're not familiar with the CRA Q&As, you can pull it up on the FDIC website. It's out there. It's basically an interpretation of the regulations, which have a lot of gaps in it. and it was last updated in 2016. And if you're looking, if you just type into the search bar, SBIC or RBIC, it'll point out every reference in the Q&As, and you'll find where it says that they do qualify. And then actually, if you're a small bank, you can also, if you want to enhance your rating, you can request that the examiners review the performance on qualified investments if you've invested in an SBIC or an RBIC. So if you're a large, small, or intermediate-sized bank, you can receive credit under CRA. Okay, the next slide, please. So if you're not familiar or that familiar with CRA, one thing I want to point out is the community development, which you'll hear a lot about, is specifically defined under the CRA regulation. And they are what we call 4 key prongs to community development. One is affordable housing for low-income people. Another is community services targeted to low and moderate income people. And the third one, which is where SBICs and RBICs fit in, are activities that promote economic development by financing small businesses or small farms. And we'll talk more about this in a bit, but this is where it fits. And then the fourth activity, the fourth prong, is activities that revitalize or stabilize low and moderate income geographies or distressed or underserved, what we call non-metropolitan rural areas or middle-income rural areas. So let's look at the next page and talk a little bit, next slide, a little bit, what do we mean by economic development? And this is one of those definitions that is, more clearly spelled out in the Q&As. And when you look up economic development in the Q&As, the agencies, when they publish the guidance, they said that they'll presume that any loan to or an investment in an SBDC, an SBIC, an RBIC, or New Markets Venture Capital or New Markets Tax Credit, these are eligible community development entities that promote economic development. So all of those activities are clearly, indicated in the Q&As to promote economic development, and economic development is one of the prongs of community development. So it clearly counts for CRA consideration. And there's no distinction between whether or not you want to invest in a single deal or invest in a fund. So it all depends upon, what your opportunities are. Sometimes regional and national funds may be a more efficient and effective vehicle for investing in community development. And that's fine, as long as you're meeting the geographic requirement. So, both an SBIC and RBIC will qualify as a, qualified investment under CRA. Okay, go on to the next slide. All right, we'll talk a little bit on the next slide about geographic requirement, because this is I think, an area that a lot of bankers and the examiners sometimes are confused by. The geographic requirement says that any CRA qualified investment, not just an SBIC and RBIC, it has to benefit the bank's assessment area, so that's clear. Or it can benefit a broader statewide or regional area that includes the bank's assessment area. So so this means that it doesn't necessarily have to be in the assessment area or have an investment in the assessment area or portfolio. It doesn't have to have a small business in there. As long as the mandate is to sort of serve the entire area, then the bank can claim CRA credit for that. And the regional area could be, it could be an intrastate area or a multi-state area. It could be things like the Appalachian Regional Area, like the Tennessee Valley Authority. I mean, it sort of depends, but it's not just, a small area. It's usually a contiguous area defined by sort of different patterns. Let's look at the next slide, and we'll talk about this a little bit more. So, again, I just want to make this clear because I know people are confused about the geographic requirement. So again, if in the prospective, the purpose, the mandate, or the function of the organization activity includes serving the geographies of the bank's assessment area, the bank can get credit, even if it's not directly getting an immediate or direct benefit. Okay? So, in other words, the fund may not yet have made an investment in the bank's assessment area, but it might do so. So that's fine. The second one is If a bank has sort of satisfied all the needs of its assessment area, or if it's been responsive to the community development needs in its area, then it can invest in a fund that is in the broader statewide regional area and still get credit, even though its mandate doesn't necessarily say it's serving your assessment area. So the fund does not necessarily have to make an investment in the bank's assessment area. It can make it somewhere else in the wider regional area that includes the bank's assessment area. But even if the mandate doesn't, include the bank's assessment area, if the bank has satisfied its needs, then it can get credit there as well. So I hope that's clear. Okay. The next slide. So what kinds of documentation would be useful for you to provide to your examiners? It's important, of course, to provide, documentation to support the geographic requirement. That's an important requirement no matter what the investment or activity is. You don't have to have a side letter specifically or note that's there, documentation that's earmarked specific investments in your area, but you should certainly have some kind of documentation. And again, the examiners aren't going to specify what kind of documentation they want, but they'll be open to anything that reasonably demonstrates that the purpose, the mandate, or the function of the fund meets the geographic requirements of CRA, or that it benefits the bank's assessment area or broader statewide regional area that includes the assessment area. So this would include things like, if we go to the next slide, let's look at some of the things that might be helpful. Obviously, the fund perspective would be helpful, but it's also helpful if the fund managers could provide documentation that sort of indicate how impactful the fund is, or how responsive it is to the needs of the area. So it might also list specific businesses that are meeting a particular need in an area, like healthcare or technology. They might also talk about, if they have a fund, they might talk about pipeline projects that could be in the bank's assessment area but have not yet been invested in. They could also, if the fund has never invested in the bank's assessment area, are there other things that they're considering investing in that might benefit the bank? For the banks, if you're looking at like a regional national fund and you sort of look at its track record and it's never invested in your assessment area, you should sort of question whether or not it's realistic to expect that the bank would ever, benefit from this fund. And you should also consider whether or not the investment, even if it's not directly invested in your area, is there a way to show that there's indirect impact from investing at the regional level? I mean, these are things that the fund managers might be able to think about and provide. I know I heard, talk about metrics earlier. Number of jobs created. That also shows that, how responsive the fund is or the investment is to meeting the needs in the area. And then, of course, if there's a government-sponsored plan that supports deals targeted, that would also help the bank in showing responsiveness. And again, these are not requirements. These are sort of suggestions on what types of documentation might be helpful for the bank to show the examiners that, one, it's meeting the geographic requirement, and two, that it's being responsive or impactful in making these investments. Okay, so the next slide, how do you identify suitable SBIC investments or RBIC investments? Well, you have two fund people there, practitioners. You can talk to them. You can also contact the SBA to identify SBICs or RBICs, SBICs currently raising funds, or the USDA for RBICs. And then, obviously, like any investment, the investment should be consistent with your bank's financial condition, your risk profile, and your risk tolerance. When you're choosing an investment or a fund to invest in, it should be reviewed with your, against your investment strategies, with your senior management, and it should be consistent. And, you should evaluate the risk and return thoroughly, just like any other investment. Recognize that the invested capital is at risk. SBA can leverage the increased return, but it also increases the risk and delays on the return of capital. And then also recognize the illiquid nature of the investment. So just like any investment, you have to do your due diligence, which really leads us to the next slide. You know, this generally says, like any investment, do your due diligence. Make sure it meets your strategy. Make sure you have everything in place, and you would review it like you would any other investment. And then the last slide, or the second one, the next slide, process to manage investments. You do want to make sure if you invest that you do have a process in place to manage these investments going forward. You don't want to just make an investment and forget about it. You do want to make sure you're tracking it regularly, looking at its investment valuation and the performance reviews, and then, you know, having mechanisms in place for reporting. And then obviously, you know, the fund managers will be very helpful at providing that kind of information for you. And that's really for your purposes, not necessarily for the examiners. And then just the last slide is really just some resources that'll that you could sort of refer to for more information on mostly SBICs. I don't think I have anything on there in RBICs, except for what's in the Q&As. So that's really it. You know, again, the point is SBICs and RBICs do count for CRA. They have to meet a geographic requirement, and it's helpful to provide the documentation to support the geographic requirement, as well as to support the fact that the investment is impactful or responsive to your area. So I'm going to turn it over to my colleagues, the rest of my colleagues on the regulatory panel, to see if they have anything to add to that.
Thanks, Jenny. Victor.
Yes.
So just to reiterate what Jenny said, and what also our panelists previously just said, is that from the FDIC standpoint, as far as with your examiners, for the bankers on the call in the room, I would encourage you to continue to reach out to your examiner, who is your first point of contact. And then secondly, within each of our territories, we have my counterparts within community affairs, which also is point of contact for the bankers, as well as community groups or any other partners within the community that serves the needs of the low-to-moderate community, as well as in community development. And when you do have this conversation, make sure you're transparent and really just ask the questions that to make sure that your conversation and the narrative about what you want to do as you embark on deciding if you're going to participate in SBICs or in RBICs, because that really comes down to how you effectively communicate. And then documentation is also important. As our panelists before said, that a lot of times it's about the metrics. Can you really tell the story, and does it line up with what you're trying to do, and does it impact? And so all that fits in. So I would just encourage, as you listen to not only what the panelists have said before and what Jenny just got you going through, is to really make sure that when you have the conversation, make sure the right people are in the room. A lot of times they have a point of contact for the community person, but they might not have a conversation with the decision makers, which might be the CFO or even the board of directors. So make sure that the conversation transitions and transcends from the conversation you have with maybe the funders all the way up to the management. And then also be clear about who it impacts and who to serve, not for the short term, but also for the long term. And then lastly, if you have questions or anything that you're unsure about, there was a host of resources that was presented on the slides. Ask the question. It's easy to have to start a conversation than to wait to after the fact and then say, oops, the opportunity went by. So I would just encourage everyone to reach out. If they have an interest in a particular lenders, reach out to your point of contact with the regulators. And then if you are nonprofits or even the community who are looking at to maybe get involved in small business, to also to reach out to those stakeholders who can give you and direct you to the right path.
From a Federal Reserve standpoint, I think we mimic many of the things that have already been commented on. I think the documentation is a huge piece. What we see in many of our institutions is the education part of it, figuring out where a investment like a civic in a civic would count and why it would count. A lot of time we don't have an extended period of time for our examinations, so we're coming in hoping that we have some documentation provided to us about what these investments are, what these loans are, and why the bank thinks they count. Many times we're willing and able to listen to those stories and to look at that documentation, but we don't have a lot of time to go and rifle through the bank's investment portfolio. The second part is trying to make I think a connection between the SBICs and the RBICs with the banks. I think there is an education piece there too, and understanding. I was surprised actually to hear that, you know, examiners wouldn't count an SBIC investment. I can understand sort of this assessment area issue, but the definition kind of lays it out where it can be broadly interpreted. So I was actually surprised by examiners not counting SBIC investments. Now, it will get kind of tricky because the RBIC, you know, mentioned you do investments from Maine to Maryland. So if you don't have, you know, businesses located or you're dealing with investments locally, you know, that gets a little tricky. But I was actually surprised. So the education and partnership, I think, with SBICs and RBICs, I think that statement that you made about trying to get out in front of banks more, making them understand sort of the, I guess, the automatic, usually qualification for CRA is important. And then the documentation piece on our side, which we continually try to reinforce every time we're on an exam. So,
I'm going to point out a couple of resources before we do Q&A. So because I've got emails, there are people listening with community groups. So the first she mentioned was the FFIEC, so F as in Frank, FFIEC.gov, and you can type in the search bar SBIC, RBIC, and find the guidance. And then the Federal Reserve Banks, all 12 Reserve Banks, as well as the Board of Governors, we have these fun videos that you can watch to learn more about CRA. So you can go to richmondfed.org. If you type in CRA video, they'll come up. Large financial institutions, CRA tests, intermediate and small bank tests, best practices, and we keep adding more to that. So you can, and especially the one on the definition of community development. So you can watch those videos as well for more information. So now I want to see if we have questions in the room for the regulators, including Jenny on the phone. Questions? Oh, Karen.
So a question came to us recently from a bank, or I believe examined. Oh, sorry. I usually have a big
It's a talk show here.
Thank you. So a question came recently to us about whether or not an investment in an RBIC would count either for or against their public welfare cap. And I hadn't had the question, so we actually have gone to the Boston Fed, who's now gone to the New York Fed, to ask the question, because I don't know the answer, and the bank is a fairly large bank, and they actually, their assessment area is identical to where we're focused, so we would love to have them as a partner, but we want to help them answer that question. So,
yeah,
you don't know?
I don't know either, but I can try to help find an answer.
Great, thanks.
Jenny, did you have any thoughts on that?
I think the answer is yes, but I do want to confirm that and get back, so I will let you know, Jeannie, and then you can relay that back.
Other questions in the room?
There's a couple of online questions. One is, I'm new to the community economic development sector. Please provide details regarding the information provided in the fund prospectus. And do you have suggestions to develop an attractive fund prospectus?
That almost sounds like a question for Rhonda and Karen, I think. Don't you think?
Sure. They want to know a little bit more about the details provided in the fund prospectus. And do you have suggestions to develop an attractive fund prospectus?
Well, we hope our fund perspective is attractive. And I'm sure you think the same. You know, to the point of the question of the regulator's comments a moment ago, it is important, and you know, you want to be as detailed as possible about how you're going to impact the communities that you expect to invest in. So it's a big piece of our perspectives, is explaining the underserved nature of the rural markets, but the opportunity in making investments in those markets, and what will be the outcomes and the benefits from that. So spelling that out, at least in this context for CRA, I think is, again, great to have a bank use that as part of their toolkit.
So I think, can you hear me all right? I think in your prospectus, including as much as you can about what you do and what that fund is going to do. The specifics, you might want to be careful about. Always include an attorney, of course, to make sure you're not putting anything out there that you shouldn't. But I think comments about your team and their experience, the criteria for your investment, and the life of the fund, those kinds of metrics. Can't really think of anything else. Does that help her?
And let me add one more. I had another email about information on RBICs. So I don't know the email address, but I know if you type in USDA and RBIC, you go to a page that has David on it, and he's like the fastest email responder I've ever met. So if you want information on those, you can go to USDA and RBIC, and he'll respond.
Another question from the live stream audience. The OCC recognizes an investment in an SBIC under the Public Welfare Act, up to 15% of capital and surplus. Does the Fed see this in the same way?
I would assume so, but I don't know if that's to be the case. I would assume we'd all look at it the same way.
Okay, Jenny, any other comments from you on this? We will make the PowerPoint available on the website that goes with the live stream. Did you want to make any other comments, Jenny?
No, we will get back to you on the questions regarding PWI and RBICs.
Okay. Victor?
No, continue just to reach out, utilize the resources, and consistently just about education and making sure that everyone from the top to the bottom of the organization understands. So it's about getting out and pushing out the educational forms.
Rob?
Yeah, I guess from the bank's perspective, be willing and able to ask your examiners questions. We're trying to be, and I'm hoping that we're as open and transparent to how we examine you and what the rules we are holding against you are set forward, for you to understand. So I'm hoping we're being as transparent as possible, but be willing to ask examiners questions.
Okay, and I am going, if there's no other questions in the room or online, Brent? Oh, wait, I'm walking to you.
Jenny, can you hear this voice?
They can't hear you on live stream.
Okay.
And your questions are too long.
Jenny presented a number of motivations why banks might invest in an RBIC or an SBIC, but the most compelling ones seem to be the CRA credit. Yet, Rob, I share your surprise. That doesn't seem to be universally understood. Qualifiers. Where's the problem lie in that communication? How do we address it?
I think a large part of it has to do with this assessment area sort of misunderstanding, maybe, about how this regional area, how large it can be, how far you can go, whether you're satisfactorily meeting the needs of your already existing assessment area. We do countless reviews of banks' assessment areas on the onset. So, like I said before, I think it's an education piece. I think needs to be better understanding about this investment and what it means, but I do think there's a limit too on the amount of civic investments you can hold at a bank too. So I think there's hesitation on the bank part for a certain degree, because they are a little bit considered riskier than other investments. So, but I think the assessment area definition is primarily the culprit.
And as far as just to echo what Rob said, I always think, just continue to have events of meaning like this is probably the best way, because as you look at turnover and mergers, I was sharing someone earlier that a lot of times the intellectual knowledge, folks who understand different programs may have, transitioned out, and you have someone coming in, and if within their tool shed, if this was not part of it, then they might not know that they have another tool available to them. So education on both ends, not just within the banking institute, also with examiners, to make sure that it's up front and center as part of the whole toolbox, and it's not one individual silo look.
So Victor, would you like to close us out?
Sure, I'm a good closer. So one of the things I just want to do is, again, to thank all our presenters who just brought us a wealth of information. Again, also to the Kenan Institute for hosting the event. And some key takeaways that just kept resonating in the end was, we just said in our closing comment, was it really about continuing to get the word out in the simplest form and not trying to make it complicated that we scare folks away. And as you go out, whether you're a financial institution, whether you're someone who's within the fund manager or even a regulator, is that really just having a conversation and then be able to direct folks back to the resources and dispel those myths that's out there that it is not counted as CRA, or it's risky, or it's just too much cumbersome that I don't want to deal with because I had to put a little sweat equity in. And so the challenges that was raised kept saying, communication, telling the story, documentation, communication, education, telling the story, documentation. So with that, we'll be sending out, Jeannie will actually be posting the website, the PowerPoint presentation, and then you can go back and re-listen to some of the comments. I think it'd be worth everybody who's on who's online, and even in the room, to go back and kind of revisit some of the points you might have missed that was said, because there was a lot of information that was given out by our presenters and experts in the room. So with that, if there are no other comments from our live or in here, again, here, let's put our hand together again, and applause for our speakers. Thank you for coming. And with that, we close this session. Thank you guys very much, both online and in the room, and have a great day.